I want to thank everyone who's joined us today. We hope you'll find the session informative. Let me just very briefly introduce the panelists who are on the webinar today. As Scott mentioned, I'm Phil Karter. I've focused on tax controversies and litigation for about the last 30 years, including a large number of disputes involving partnerships, and particularly TEFRA partnerships. We have Scot Kirkpatrick in our Atlanta office, who is my go-to business and estate planner extraordinaire. In his line of work, he deals with a large number of family partnerships and small businesses organized as partnerships or LLCs. Third person we have on the call today is Katherine Jordan, who comes to us from the United States Tax Court, and who has also worked a good deal with partnerships in the tax controversy area and litigation stage. Katherine also deals with international aspects of partnerships. And then lastly, we have Reid Barrineau, who you heard a moment ago, and he's kind of our jack of all trades, working in both planning on the partnership and corporate side and in controversies on those areas. Okay, so I started practicing as a tax lawyer. Katherine, if you want to go to the next slide, please. The year TEFRA came into effect in 1982. And all I can say is that I hope they don't put me out to pasture like they now have TEFRA. Actually, TEFRA was designed to help the IRS simplify audits by consolidating partnership audit procedures. It hasn't quite worked out the way Congress or the government intended, and you can see some of the reasons why. The most important, perhaps, is that taxes have to be collected from the partners, who are sometimes hard to track down or to collect from. And the proceedings can also become rather unruly because of the rights of partners to participate in the partnership proceeding. And I think you'll see from the discussion today that the solution crafted to replace TEFRA may actually have been like pouring gasoline on a fire. After you've had the pleasure of reading through almost 300 pages of regulations, what you find is that the regime designed to replace TEFRA is something of a hot mess. But like it or not, it's here, and the partnerships and partners have to be prepared to deal with it. And because, as you'll see, proactiveness instead of reactiveness is going to be an absolute essential. And what no advisor wants to hear from a client is, how come you didn't warn me, or how come you didn't prepare me? So perhaps we can further that process a little bit along. So who's affected by the BBA? Well, in one way or another, just about every partnership will have to deal with it. Now, some will have it easier than others based on certain factors like the partners who make up the partnership, certainly the type of business entity that, or individual, as the case may be, that is a partner in the partnership is going to have a lot to do with the complexity of this, as you'll hear in a few moments. Transition in ownership is another factor that's going to weigh heavily under the new law. The degree of equanimity or contention among partners is also going to be a particular factor, and agreements are going to have to be structured to take into account those partnerships that get along versus those perhaps where there's some more likely to be some differences of opinion. The nature of the partnership's business, particularly with regard to the type of income that it generates, will be a key factor under the new law, and also the risk of audit adjustments based on that business. I mean, is this a partnership that engages in the type of business that is under closer audit scrutiny? So partnerships also, a point to mention is that they won't be able to ignore the ongoing existence of the TEFRA regime for pre-2018 years. So it's not quite in the scrap heap yet, at least until the statutes of limitations expire for tax years up to 2017. Scott?
Yeah, let's move right on to common examples, if you will. I'm sure all of you have clients who are like the folks on the left, a little bit the more Ozzie and Harriet, and then there are some that are perhaps a little harder to corral together. You know, I've been practicing law, at least at Chamberlain, since 1989. In a couple of years, somebody in accounting produced a report of all my client matters, and there were over 1,000 of them, and certainly not all of them have limited partnerships or LLCs, but a lot do. no matter what form of partnership you're doing business as, LLCs, FLPs, limited liability, limited partnerships, and et cetera, those are the kind of entities that are going to be affected by these changes. It is a kind of a foregone conclusion that some issue is going to come up somewhere, and perhaps sooner rather than later. The government, wants its due, no matter how it gets it, which of course is the reason for all these rule changes. The kind of things that I expect to see are obviously more business related. If it's purely a family, particularly one that gets along well, and we're dealing with a marketable security family partnership, the chances of an income tax audit coming up and then one of these BBA issues coming up is probably relatively small. Where it is very likely to come up is, quite frankly, we have a very large number of clients that have unrelated partners using LLCs or limited partnerships, and they're almost certainly going to be tiered. That is, they'll probably have a corporate general partner or probably have a trust as an owner, which, as we'll find out later, is going to prevent you from electing out. Be these professionals, be these people who have, say, trucking businesses. I've got several very large clients that have logistics businesses, and in fact, we just sold one this past summer for a very significant sum. I think these guys had close to 30 LLCs underneath their FLPs, which were owned by trusts anyway. Now they sold, and those issues are going to go by the board before the BBA comes into effect. But those are exactly the kind of circumstances where, if there's a tax issue and in 1 year, and you've sold an interest in your business, and then the IRS comes to audit, the IRS is going to look for the partnership to get the dough out of, but that may have been sold, or you may have added partners, or all sorts of things could have happened. Could be in a family context, if you will. In my practice, it's most likely to start that way, but eventually you're going to end up with key employees or outside investors coming in, and these sorts of tax issues are going to create, I would think, a significant potential nightmare, if you will, and create disputes. I've got some technology clients, obviously professional clients, who are doing business in these forms, and you're buying people out and moving them around as they kind of go through their careers. Those are the things that the documents and the accounting for the entities need to keep in mind as we select what type of entity. Oftentimes you'll see a professional use an S corp as opposed to an LLC. Well, anyway, there is no one size fits all, as the slide indicates there. The point being that we need the correct kind of business form for the client situation. There is no one way to do it. We have sent out, I don't know how many letters I sent out. It's hundreds and hundreds of letters. I think I did that early in the fall, and I've gotten a fairly significant response back from the clients who said, put me on the list, and we're basically going to start creating the specific language for the amendment to the LLCs and partnership documents. So I think that kind of wraps up. Let's go on to the next slide.
Thanks, Scott. My name is Katherine Jordan. As Phil mentioned, I'm an associate with Chamberlain Hrdlicka, and I've been looking a lot at these BBA provisions since they came out in 2015 and since the regulations were issued earlier this year. As you can see from this slide, TEFRA and the BBA are quite different. Under both regimes, the IRS audits partnerships, but that's where the similarities end. Under TEFRA, once the IRS was finished auditing the partnership, it would allocate the tax due to each partner it deemed responsible for a portion of the partnership tax. And it would calculate the tax at the partner level, including individual tax attributes and individual ordinary income or capital gains rates. That is completely changed under the BBA. Under the BBA, the partnership in the adjustment year, which is the year the audit becomes final, is responsible for the underpayment. And because it's the partnership that's responsible, there is not an allowance for calculation of tax due at individual rates for each partner. The BBA defaults to calculating the tax due at the highest rate in effect for the audit year, be they individual or corporate. What that means is that currently the highest individual or corporate rate is the highest individual rate of 39.6%. And that has the effect of calculating the tax due for individuals at the highest rate, even if they have a lower individual income tax rate, ordinary income, or a capital gains rate, which is lower than the highest ordinary individual income tax rate. Additionally, C corporations will find themselves taxed at 39.6% rather than 35%. Another significant difference between TEFRA and the BBA is that under TEFRA, partners and partnerships had wide abilities to participate in audits and represent the partnership. The tax matters partner was the main point of contact between partnerships and the IRS, but notice partners were also allowed to participate and receive communications from the IRS. The Bipartisan Budget Act does away with notice partners entirely and replaces the tax matters partner with the partnership representative, who is the sole point of contact between the IRS and the partnership. The partnership representative has wide latitude to bind the partnership. And if anybody on the call is a fan of Lord of the Rings, you should think of the partnership representative a lot like the One Ring from Lord of the Rings. Because if you have a bad partnership representative, that partnership representative can do very heavy damage to the partnership. The partnership representative is appointed on each annual return. What happens if you don't appoint a partnership representative? The IRS gets to appoint it for you. And I don't know of many partnerships who would want the IRS to be able to choose who is representing them. Additionally, the partnership representative is almost unremovable once appointed. Unlike the tax matters partner, who can be appointed and removed fairly easily, and who represents the partnership for all tax years, the partnership representative is an annual election that is very difficult to change. The regulations give an example that if a partnership appoints partnership representative A to represent the partnership during tax year 2018, and partnership representative B to represent the partnership during 2019 and 2020, a later audit of 2018 will still have the effect of having partnership representative A represent the partnership during the audit. So a later appointment of a different partnership representative does not remove the previously appointed partnership representative. For this reason, we strongly suggest that partnerships use an entity partnership representative, because the entity partnership representative allows the appointment of what's called a designated individual. And the designated individual is much easier to remove and replace than the partnership representative. Additionally, because the Bipartisan Budget Act does away with notice and participation rights, partnerships will have to contract to require the partnership representative to effectively allow them to participate in any audit before the IRS. And then finally, because the partnership representative may be assuming some contractual liabilities, a partnership representative may require indemnification for its actions or be unwilling to serve. Treasury has described this as vesting power back in partnerships, but that's a little bit of a misnomer, because the default is that the partnership representative has wide authority, and it provides a reason why partnerships need to amend their partnership agreements, or LLCs need to amend their operating agreements in order to provide for contractual protections against the partnership representative's authority. Unfortunately, the proposed regulations do say that the IRS will not be bound by any limitations on the partnership representative's authority in the partnership agreement.
Just a point about that. So just because the IRS doesn't necessarily follow what the parties agree to, that doesn't mean there aren't contractual rights of action by partners against other partners or against the partnership representative if the partnership representative acts in a manner that is contrary to what the agreement provides. So notwithstanding the IRS's own respect of the arrangement, the contractual arrangement, it's still important as among the parties to clearly define what those rights are going to be and the limits on those rights.
Yeah, this is Scott. I couldn't agree more with Phil. The time to decide these issues is when you're doing the deal. Now, there'll be a lot of amendments to pre-existing documents, but this will be a point to negotiate going on down the road because we're going to be faced with a partnership audit at some level. So particularly if there are non-family members or key employees or whatever in these deals, we need to have these provisions in the document to deal with the tax issues.
This is Reid Barrineau. Some of you may have heard me speak earlier. I work primarily with Scot Kirkpatrick here in Atlanta. And I wanted to touch on how clients can potentially avoid this issue. So the general rule of the new Bipartisan Budget Act and these partnership audit rules is that all determinations are made at the partnership level. And right below that, section 6221B, there's an opt-out provision. A partnership can opt out if it has 100 or fewer partners who are individuals, C corporations, or S corporations. And the proposed regs further expounded upon that and specifically said that partners who are another partnership, so our tiered partnership structures, a partner who is a trust, a disregarded entity, or a nominee are not eligible partners. And in the determining the 100 partner limit, for instance, the regulations mention the S corp. You look at the number of K1s issued. So if a partner is an S corporation and there would be 4 shareholders of the S corporation, you have the S corp itself counts as 1, and then each of the additional shareholders count. So you can easily see potentially how the number of partners you get can increase very quickly depending on whether there is a C or S corporation, or particular S corporation partner. And as I said earlier, many existing structures are going to be ineligible to opt out. As Scott deals with regularly, there are other reasons why the ownership structure may be what it is. There may be an estate planning motivation where the partnership interest is owned by a trust, or if there is a tiered partnership structure in a family limited partnership. So you may be unable to opt out. However, the consensus opinion at this time is if you are able to opt out, opting out is the way to go. The goal of the Bipartisan Budget Act is to make revenue collection easier for the IRS. So our general thoughts are, don't make it easier for the IRS. If you can elect out, elect out. Everything in this new audit regime is designed to make it easier for them to assess and collect taxes. And one thing you'll need to address, though, again, and this may be in some of the existing agreements, is how, if you opt out of the new partnership audit regime, how exactly things are going to be handled if you opt out, such as who's going to bear the cost of an audit. Will each partner bear that themselves? Will the partnership pay for defense costs, that sort of thing? Next slide.
Yeah, we're on that now.
Okay, if you can't opt out, there are still other elections. One of them being the push-out election under Section 6226. So, as I said, the default rule is that items of gain or loss and tax are determined at the partnership level. The push-out election allows the partnership to elect to push out that liability to the individual partners for the reviewed year. So we're going to use these concepts of reviewed year, adjustment year. Reviewed year is going to be the actual year under audit. Adjustment year is going to be the year in which the auditor is going on. So if you're having an audit of the 2019 return in 2021, 2019 is going to be your reviewed year. 2021 will be your adjustment year. The regulations specify how and to make the election and what has to be included with the election. And it's just kind of some formal requirements, nothing particularly complicated there. However, you should know that even if the partnership makes the push-out election, it still has some obligations to provide the push-out partners with certain statements and provide those to the IRS. So just because your partnership makes a push-out election does not mean the partnership is absolved of any obligations at that point. Next slide. I think it was Phil or Katherine touched on earlier the modification procedures, particularly rate modification in this new regime. One of the pitfalls that they've really placed in there, really more of a landmine, is rate modification, where if an adjustment is made, it's made at the highest rate under sections 1 or 11. And as someone was saying earlier, you could effectively have, based on an adjustment, a partner could go from paying tax on an item of long-term capital gain at, say, 15% to currently 39.6%, and I think there's even a provision in one of the proposed tax reform plans that includes a kind of a bubble bracket of about 45.6%. So you could, as you can see, you can easily double to triple the economic impact of an adjustment under Section 6225. So partnership really needs to pay attention and make sure that modifications are timely requested so that the effect of the adjustment isn't multiplied through rate increases. And we're actually go ahead, Phil.
Sorry, I was just going to jump in. I just want this to sink in a little bit because, first of all, the modification procedures, I think it's fair to say, are among the most complicated and convoluted of the proposed regulations. But the bottom line is, imagine, for example, that you're involved in a real estate partnership and there's a valuation question that comes up on audit, which has an impact on, for example, the amount of capital gain reported, and there's a proposed adjustment based on that, the IRS's own valuation to adjust that capital gain, and it's long-term capital gain. You know, under the current regime, that would pass through at the much preferred capital gains rates. What Reid and Katherine and the rest of us are saying here is that absent any effective action to effectuate modification procedures, which are complex in their own right, you're going to be turning a tax that might be taxed at a 22.6% rate all the way up to 39.6% or higher. And we haven't even talked about the implications on the state tax side, because states still have to catch up on this. But if the tendency is to mimic what happens on the federal side, you could be looking at a tax rate applied to an adjustment that is far, far in excess of what it is under the current law.
Exactly. I think this is probably, Phil, in our discussions, we think one of the biggest potential landmines in this legislation. And it's really something that you have to pay attention to and stay on top of, because it'd be one of those things during the audit process that if you miss could just be, as Phil said, exceptionally costly. And because of that, it's probably something you want to directly address in any amendments to partnership agreements. You probably want to contractually provide for that a modification is going to be requested to ensure that this doesn't happen, and that duty is affirmatively placed on the partnership representative. Next slide. Yeah, again, we go back to the push-out election here about the liability being pushed out in some later year. You know, again, say we're in 2021 and we decide that we make a push-out election and the obligations are pushed out to the reviewed year partners, or who were the partners in 2019. So we have this dilemma. You know, as you can understand, there may be competing interests. In some of these family entities, the partnerships, the interests don't turn over. However, in some operating entities, they turn over with regularity. So we're going to have somewhat of a two competing interests between the reviewed year partners and adjustment year partners, and what their obligations are going to be to one another. Another consideration you have to make here is the cost of the push-out election. As the slides indicate, there's an additional 2% interest on deficiencies. Therefore, the push-out election, if you have a partnership which is fairly stable in its ownership, you may want to provide in there that you do not want to make a push-out election in order to mitigate any additional costs of an adjustment.
So here's a perfect example where a contractual provision can save everybody money by effectively adopting the push-out effect, but keeping it in the partnership for a deficiency. You can save that 2% interest. If you don't address it, however, you don't have that option. These are all the types of things you have to consider because they're not changes you can realistically make after the fact.
Exactly, and I think that concludes what I have on this slide. Next.
Okay, so look at the implications here, particularly in the absence of contractual provisions to address. And I know that's been a mantra I've kept repeating here, but you can see, number one, you can effectively bear the cost. A current partner can effectively bear, or all current partners can effectively bear the cost of former partners. That's first of all. You have these adjustments that will be taxed at much higher rates, potentially, than more favorable rates such as long-term capital gains or qualified dividends through a very Byzantine process. Third, you're likely to have very little say over what the partnership does or how it defends an audit unless you plan in advance by provisions in the agreement that either require the partnership representative to undertake certain actions or to prevent them from undertaking those actions. And then on the other side, even partners in the existing partnership have interests to protect, such as in the case of refunds, because if you're a partner that leaves the partnership and in the audited year, in the reviewed year, to use the correct terminology, a refund ultimately is determined to be due the partnership. If you don't account for that in advance and you leave the partnership, you don't get it. The folks who replaced you get it instead. So once again, it's not all a one-way street. I mean, there are interests that former partners have, and there are interests that current partners have, and they don't always align completely. You want to go to the next slide? Okay, so the point of all this is that negotiations and partnership agreements just got a lot more complicated because the business deal has gotten more complicated in the case of a partnership tax audit that can have meaningful consequences, particularly in the case of a large adjustment. So there are all kinds of provisions that have to be reviewed, discussed, agreed upon, and as noted earlier, one partnership is different from the next, at least to varying degrees. So if you're a draftsperson of these agreements, the trap you want to avoid is to just use cookie-cutter language for each transaction. This isn't just about putting in the type of boilerplate language we're all used to seeing with respect to special allocations, substantial economic effect under Section 704. So while obviously there'll be some overlap from one transaction to another, the enormous power vested in the partnership representative to bind the partners requires a lot more thoughtfulness about the issues that have been raised today. Now, you want to go to the next slide? So here's an example. How do partners protect themselves from being damaged by partnership activities giving rise to adjustments they had nothing to do with? And we must think about how to contractually provide for these safeguards. And this is a good time to point out that the interests of current partners, former partners, and even the partnership are not always aligned. So as advisors, it's important to remember who you represent and what you're trying to accomplish for that particular client. And for clients, your position is going to bear on what's important to you. Are you likely to be selling your interest and be a former partner at some point? Are you likely to be acquiring an interest? So depending on the position you're in, you're going to have different needs. And that's why it's important to thrash all these things out or to hash all these things out in advance. As noted in the last bullet point here, a partner likely to dispose of his, I really just said this, to dispose of his interest has a very different point of view than a partner who's coming in. But there's a level of due diligence that is going to have to be enhanced because we're going to have to deal with issues that partners have not really had to deal with before. Katherine?
Yeah, as Reid discussed, partnerships who are eligible to opt out will definitely want to try to retain that eligibility. The partnerships may want to consider whether they want to restrict new partners in order to maintain the ability to opt out. And ineligible partnerships may also want to consider whether they should restructure in order to obtain the opt-out ability. Additionally, because the default under the BBA is to stick partnership with the tax liability, partnership agreements should consider whether to treat a payment of the tax by the partnership as an offset against the distribution to partners, or provide for some kind of holdback of distributions to cover potential future liabilities. Not every agreement is going, or sorry, not every audit is going to result in the right partners paying the right tax. So partnership agreements should provide for the allocation of tax among partners who do not get indemnified by former partners. And then finally, partnership agreements definitely need to have enforcement provisions in place to make sure that the contractual provisions are actually effective in getting former partners to pay the tax due and making sure that tax is paid at a lower rate.
And I wanted to pick up on one thing Katherine said about some of the planning. One provision that we've discussed and that we think may be appropriate in some of these agreements where you were attempting to maintain your eligibility to opt out is a provision similar to what many of us are used to seeing in an S corporation shareholders agreement, that no shareholder will take any action which will cause the corporation's S election to terminate. Similarly, a provision like that may be appropriate to have in there, that no partner will take any action which would cause the partnership's eligibility to make, or would terminate the partnership's eligibility to make the opt-out election. Again, if that's very important, one of those provisions is a must-have in the agreement. If you can't opt out and you have to name a partnership representative, this is probably going to be one of the bigger considerations the client has to make with respect to this new audit regime. And this is going to be very important because I think most of you as advisors are going to kind of know the client's dynamic and who in the partnership, whether it's the matriarch or patriarch, or whether it's one of the children who's also a partner, who is going to have that ability to kind of manage the competing interests and kind of do what's best for the group, get everyone on the same page. This is not an area where you're going to want somebody who, kind of is very self-interested or is going to have a difficult time getting along or convincing others of the proper course of action. Notifications are also a huge question mark in this area. We talked about earlier that kind of you have these three types of partnerships. Well, for a number of Scot's clients where, grandma and grandpa own the partnership and children and grandchildren have various interests, you may not be as concerned about notification where, everybody trusts grandma and grandpa to make whatever decisions are best for the family and for business, or that sort of closely held, leave it to beaver type family arrangement. However, where you have operating businesses, particularly those with unrelated owners, it is imperative that every owner receive notification of any audit proceedings. Because, as you can see, the potential impacts upon them are substantial. So this is going to be very, very important to clearly define what each partner's rights are with respect to receiving information, and as a corollary, what the obligations of the partnership representative are to disclose that information or provide that information. And another thing you have to consider here, as we've talked about before, some of the people to whom you're providing information under these circumstances may no longer be partners. Keep in mind that if there's a push out, you may have an obligation to provide this information to reviewed year partners who are no longer with the partnership. Another question again is, how much discretion are we going to give the partnership representative? Again, that is going to very much be determined by the dynamics of each partnership, and that's going to vary wildly from closely knit family that gets along to operating business with unrelated owners. Again, the IRS is not bound by anything in terms of the partnership representative has absolute discretion when dealing with the service. What you're doing, as Phil mentioned earlier, is you're protecting the partners and providing contractual remedies in case a partnership representative exceeds his or her authority in dealing with the IRS. And lastly, the compliance and defense costs. All of these agreements need to clearly spell out who's bearing the cost of this, and with the complications of push out, elect out, where the liability is going to go, there are very well going to be competing interests, and that the partnership may not want to bear the liability if the obligation for the tax adjustment is going to be pushed out to partners, many of whom are no longer with the company. So these are the sorts of things you need to carefully consider and plan for when amending partnership agreements. I'll pass it over to Scott.
Let me just add a quick point about the last item. I mean, if you think about it for a minute, you might have a big money partner who's basically a passive partner, not directly involved in the operations of the partnership, and you've got a big adjustment you're looking at. The partnership opts out, and all of a sudden you've got this passive partner who is effectively having to defend themselves. Now, in one respect, that's not all that different than small partnerships under the current law. Problem is, all the information is really in the hands of the partnership. So there really has to be, at a minimum, some way to have coordination in mounting a defense in the case of an opt-out by the individual partners as opposed to the partnership. So you've got two issues, who's going to pay the cost, and then who's going to put that partner in the case of an opt-out if they're defending themselves to be able to mount a reasonable defense. Okay.
All right, thanks, Phil. Hey, this is Scott. Obviously, careful planning is essential. I'm probably preaching to the choir at this point, but it's best to get on this, if you will, and amend these partnerships sooner rather than later. I think the slide actually says sooner is better. Obviously, that means getting things done along with everything else that needs to be done prior to January 1st, of course. We're pressing ahead with those partnerships who want to do that, of course, but my guess is we're going to be amending these things well into 2018. And of course, for new partnerships, which we sign up next year, we'll have already done these amendments. As we've kind of already noted, when we create these things, we need to be very cognizant of these issues, whether it's a family limited partnership, because these issues are going to come up, or if it's a business deal between two unrelated people or three unrelated people or whatever. Obviously, the more unrelated partners there are in these things, the more important it is to make sure we've dotted our I's and crossed our T's. There's going to be, of course, plenty of due diligence, if you will, in bringing in partners, particularly if you're bringing in an entity level type partner, as you won't be able to opt out. Anyway, opting out, as it says at the very bottom there, it requires an annual election for the partnership. So again, I'm preaching to the choir, I know, but thinking about these things, similar to the way you probably think of things for a buy-sell agreement for a corporation, particularly an S corporation, it's just going to have to be thought through. Next slide.
Okay, so, I mean, let's all be realistic here. We've got tax reform proposals that are literally changing every day. So there's a lot of uncertainty about what rates are going to be, how they're going to be applied, and whether this is even going to pass, and if it does, what form it will take. Some of you may know that one of the provisions in, I believe it's the House bill, and maybe the Senate bill also, refers to the potential for a preferred rate for certain types of income that are passed through from partnership LLCs and the like. However, there's a distinction to be drawn between pass-through income and loss partnership that is reported and accepted by the service and adjusted to partnership returns. We're talking today about the adjustments. So if for example, if a higher rate, a 39.8% rate is applied, it's applied to the amount of the adjustment. So on one hand, it's interesting, and I don't think Congress has really thought it through all that much. you've got a proposal to give a pass-through, basically an additional advantage by cutting rates for income that comes out of that pass-through. On the other hand, you're penalizing partners who participate in these arrangements by jacking up the rate potentially for any adjustments that are made. So it's certainly going to keep the accountants busy. Anyway, to get back to the point about
not to mention lawyers,
right, where we're drafting these agreements. So there's no question that people need to be thinking about this, or should have been already. People need to be acting on it. There's absolutely no question. But let's be realistic. It's now approaching Thanksgiving, and the likelihood that a lot of these are going to be in place by the end of the year is pretty low. So realistically, if you want to bind a partner who leaves the partnership before the new amended agreement is signed to bind them, it really has to be done at least by that point. You think about it, you can't push out a liability to a former partner if that partner was not party to agreement. There's no contractual relationship that binds them in that regard. So if you have the type of partnerships where the partners are coming in and transitioning, and if you don't have restrictions on sale where you can affect the timing of that, that really needs to be in place, whether it's before January 1st or after. It certainly should be in place before you've got a partner that departs, because they're out of the mix then. Now, on the other hand, they may also be out of the mix to get any refunds that are due the partnership, but it's important to be thinking about that and trying to get an agreement in place if that's your likely situation. Similarly, the second point is you're either forming a partnership or you are bringing in new partners. You heard earlier in this conversation that if at all possible, the best thing partnerships can do under the BBA is choose to make it not applicable by opting out. So eligibility, if at all possible, to opt out is imperative. And at a minimum, when you're bringing in a partner, particularly if you qualify before that partner comes in, but if that partner comes in can destroy your eligibility, is something that has to be thought about and has to be addressed in the partnership agreement. So I would say that that's another instance where these agreements should be amended before you're bringing in new partners that could potentially subject you to a regime that you could otherwise opt out of. We'll go back to our Leave It to Beaver family. Nothing much is happening here. There's no question it has to be done. If it doesn't happen immediately, it's probably not the end of the world. But we need to point out that, as I believe it was Reid said, you do not want the IRS appointing your partnership representative. And if you cannot opt out, which is also something that needs to be defined in the partnership agreement, then you need to make sure that agreement is in place before you're filing that next year's return, because you have to designate the partnership representative. So anyway, some word to the wise. We all know it's out there. We all know it's coming. We all know that it's probably going to be a very messy nightmare for some time to come. These are proposed regulations. There continues to be commentary, and I'm sure that there will be certain provisions that change. But as in many instances, this is really all partners have to go on. So while it's possible that further amendments of agreements will be necessary in years to come, for right now, there's little question that there are some fundamental issues that must be addressed, and the sooner the better. I think that's what we have for the presentation today. We wanted to leave some time. We've gone about 45 minutes in. We wanted to leave some time if anyone had any questions today. You can either type them in, or if anyone's on the phone and you have your sound on, please just feel free to ask away. Don't be shy. Nobody? It all makes perfect sense.
Absolutely. That's why I memorized it.
Okay. Well, if there are no questions, of course, if something comes up that you think of and you want to follow up, please feel free to get in touch with any of us. I think what you're going to find down the road is that issues are going to percolate that we haven't necessarily addressed today, and perhaps even in the regulations haven't been well thought out. I can give you one example. which has to do with the implications of a modification that requires partners in the reviewed year to amend their own returns to report the additional amounts. And we've had a lot of internal discussions about what this means exactly. If you think about it, you're a partner that is in a partnership that had an adjustment proposed by the IRS, and that's an adjustment that the IRS, or you believe, the partnership believes, is defensible. So the partner is now the partner now has to effect a modification, and by the way, that modification requires that you pay the tax in full to effectuate that modification, which, as my colleague said earlier, is the best way to ensure that you're getting the appropriate rate reduction that would be applicable to those items of income that you otherwise might not get if it's taxed at the partnership level. So you pay. Now what do? Can you go to tax court? Well, tax court requires that there be no full payment. In fact, if you pay the liability in full, the tax court has no jurisdiction. So if you pay the tax, you're now in a position where you have to go to refund court if you want to seek a refund. There's a lot of problems with that, even potential due process problems that haven't really been flushed out, or for that matter, thought about very well by the draftspersons of these regulations. So it's not to say that all the questions have been answered, but we do know that this is coming into effect in a little more than a month, and some of the questions have been answered, and we know what has to be done, at least until and unless changes will be implemented that will allow us to either backtrack a bit or re-examine some of the provisions that are in there. In other words, we can't afford to wait to predict what may happen down the road. We have to deal with the here and now, and for that reason, as I said, if you're a professional advisor and clients are asking you about this, yes, it's important to address this issue. If you're a client and you're personally affected by this, absolutely, you need to be thinking about this now. Anyone else, any comments?
So I saw a question from someone who wanted to know whether or not it's appropriate to appoint the partnership or the BBA as the partnership representative. Unlike the tax matters partner, the partnership representative does not have to be a partner in the partnership. But as I think we've tried to stress, the partnership representative has wide latitude to bind the partnership. So if you're a CPA, you want to think twice about whether or not you want to assume that role, because you might be opening yourself up to some contractual obligations that did not previously exist under the TEFRA regime.
There's actually there's considerations on both sides. From the CPA's point of view, you want a fairly robust indemnification that, as long as you act within the scope of your authority, whether that is authority by default under the regulations or as limited by the partnership or operating agreement, you'll be indemnified by the partnership for any costs that are incurred if there's a challenge to that authority or the actions taken. Subject, of course, to the normal gross negligence standards or whatever. On the other hand, from the partner's point of view, if you are using an outside partnership representative, you have to be, once again, concerned that they don't have the same vested interest in these things that you do. Obviously, professional advisors all have their clients' interests at heart, but that's all the more reason why it's important, and it's really important for everyone, even the accountant. It's important to clearly define the rights and obligations of the the partnership representative, whether they're an outside advisor, a CPA, or the like, or actually also a partner or member. Did that answer the question? Hopefully.
Phil, if I could chime in, I think for those of you who deal with estate planning at all, and Scott, I think you could probably speak to this as well. I think the sort of waiver as an advisor, the sort of indemnification you're going to want is almost the same as a corporate trustee who is serving as like an administrative trustee of a trust. For instance, like a Delaware trust company or a Nevada trust company, where they are serving for certain legal purposes, but they're not really making substantive decisions. They are going to want extensive, waivers as to liability and things like that if you were going to serve in that capacity. And I think the thing that also, Phil, that we had talked about is one concern any advisor should have in doing this is not just the legal ramifications of it, but what this potentially would have the potential effect on your client relationships would be. You know, if your partners may have adverse interests here, and you know, you really may have a great relationship with, you know, a number of the partners, and you could end up putting yourself in a very difficult spot by agreeing to serve as a partnership representative.
Yeah, so I think the takeaway is for the accountants on this call is, you know, just approach it with your eyes open. Those are some of the dynamics that can complicate the client relationship. The client may want you to do it because they don't have anyone else to turn to, or you're a trusted advisor, and that's all fine. But understand that there are complications that can arise from that. Sometimes the better alternative is to have a partner performing that role and have the trusted advisor acting as a trusted advisor who doesn't have the legal obligations necessarily and the potential exposures that they otherwise might if they're actually the partnership representative. But again, you know, there are certain instances, small partnerships or the like, where, you know, these implications are not as significant. So, but as a general rule, I would say just be wary if a client is asking you to perform that role, and make sure that the adequate protections are in place, both for you and for the client. The point being that the more clearly defined these rights and obligations are, the better off everyone will be. Looks like another question came in. Are there any articles you can recommend or issues to deal with regarding partnership agreements and purchase and sale agreements of partnership interests? I assume you're talking about the under the new BBA. I mean, what I can tell you, there are reams of materials that have been written about this. One of the problems that I find, and I look at them as well as everyone else, is that a lot of the articles you'll read will more or less mimic what's in the legislation or the regulations, but don't provide a whole lot of interpretive advice as to how it should be dealt with. And that's one of the points of having these seminars, so we can kind of get behind the plain language and figure out what it all means. So, but, you know, we can, why don't you let us noodle on that, and we can follow up with you. We know the person who asked the question, and we can try to follow up with you with some recommendations. Okay.
Bill, I'd also add, you know, there's a great book just on subchapter K. I think it's called The Logic of Subchapter K. And it's not going to have the BBA in it unless they update it between now and, you know, unless they've updated it, which I doubt. But that's a good great general book on partnership taxation.
You know what? Just a final comment is that one of the reasons why partnerships and LLCs have just exploded in terms of their utilization. It is, I think, as mentioned in the first slide, the fastest growing type of business form of any that's used in the United States, and growing at an accelerating rate, is because of the flexibility that you have in those arrangements. You've got flexibility in terms of allocations. You've got flexibility that goes perhaps in many instances far beyond what can be accomplished in another type of business vehicle. And the point of all this is that now you've got other issues that you can have some flexibility with in terms of contracting for them and providing for them that deal with this specific issue, which somewhere along the lines many partnerships will have to address. So the flexibility of partnerships and limited liability companies is still an important attraction to operating in those types of vehicles. Nonetheless, one has to consider with these new implications that this is going to add to the need to account for that flexibility. It's a mantra I think you've heard from all of us all over all throughout this webinar. Just prepare, think about, figure out what the potential implications are, and then put an action plan together to address those implications along with your professional advisors.
All right.
Okay, if there's nothing else, I think that pretty much concludes today's meeting. We did keep it under an hour, so that's good. And we want to thank everyone for participating today. As I said, you've got all of our contact information. If anyone wants to reach out with a question they either didn't want to ask today or didn't think of, by all means, feel free to get in touch.